Watching a chart, price drops hard for higher levels and slams into what looks like a solid support area, and you sit there patiently waiting. I'll buy when it comes back to retest. But the market never comes back. It reverses way before it reaches your level, rips to the upside, and you're left sitting on the sidelines watching the entire move happen without you. Sound familiar? Now on the flip side, some of you do catch the retest. You enter the trade, price bounces for a second, and then smashes straight through your support level like it was never there. Your stop loss got hit, and you're wondering, what just happened? That level was supposed to be support. Traditional support and resistance will only take you so far. The areas where price actually reverses aren't random. They're the exact levels where institutional traders placed massive orders that haven't been fully filled yet. And if you know how to find those levels, you stop guessing and start trading where smart money is actually positioned. These levels are called order blocks. And today, I'm going to show you how to identify the valid ones, not the garbage areas that most YouTube tutorials teach you to mark. There are specific rules that separate a real order block from a fake one, and if you don't know them, you're basically trading blindfolded. So let's get into it. What exactly is an order block? Let's say the market is pushing higher, making higher highs, and creating valid breaks of structure as it goes. Now, in this situation, a big institutional buyer, smart money, wants to enter a long trade based on this bullish market structure. But here's the problem. They can't just place a single market order and get their entire position filled at one price the way you and I can. See, when you or I enter a trade, our position size is small enough that the market easily absorbs it. Our order gets filled at one price, no issues. But when an institution tries to buy, like 500,000 contracts at a single level, something very different happens. The moment they place that massive buy order, the sudden flood of buying pressure causes the price to spike upward immediately, which means they end up paying a much higher price for a large chunk of their order, essentially buying at a premium they never intended to pay. Let me put some numbers on this to make it concrete. Say smart money wants to buy 500,000 contracts at the $20 to $25 price range. But at that level, there are only 200,000 sellers available, so only 200,000 of their 500,000 contracts get filled. The remaining 300,000 contracts, they'd have to chase prices higher to get those filled, which would eat into their profit margin significantly. This is exactly why big institutional buyers and sellers never place their entire order at a single price point. Instead, they spread their orders across a zone. They place orders in layers at slightly different levels within a defined area. And if for some reason all their orders don't get filled on the first visit, smart money will engineer a move to bring the price back to that exact same area to fill the remaining pending orders. That's why you see prices shoot up from a certain zone, then come back down to that same zone later, only to reverse sharply upward again. Those pending orders that were left behind are now getting filled on the retest. So in simple terms, you can think of an order block as a supply or demand zone where big institutions execute their orders in the market. Now that you understand what an order block is, let's talk about how to identify them on a chart. But first, let me show you how most retail traders do it, because it's the wrong way, and I want you to avoid this mistake. Most traders learn that in a strong uptrend, whatever green candle starts the big bullish move, the last bearish red candle right before that move begins is the order block candle. And in a strong downtrend, the last green bullish candle right before price drops aggressively is the order block candle. This is the most common and also the most flawed approach to marking order blocks. Because what's happening here is you're marking order blocks without checking any of the validation criteria, the techniques and rules that separate a real order block from a fake one. If you mark order blocks this way, you'll be wrong most of the time, and your losses will pile up. So to identify a valid order block, you need to understand a set of specific rules. Let's go through them one by one. Rule number 1, last candle liquidity sweep. In a bearish price action setup, let's say the market makes a strong move to the upside after a certain bearish candle. Now, for that candle to qualify as a valid order block candle, it must have broken below the low of the candle before it. By doing this, it swept the liquidity sitting below that previous candle. This liquidity sweep confirms that smart money stepped in at this level, so this makes it a valid order block candle. But if that last bearish candle did not break below the previous candle's low, meaning no liquidity sweep happened, then it's an invalid order block candle. Without the sweep, there's no confirmation that smart money was active there. The same logic applies in reverse for a bullish market structure. If the last bullish candle before a big drop broke above the previous candle's high, it swept the liquidity sitting above, making it a valid order block. But if it didn't break the previous candle's high, it's invalid. Think of the liquidity sweep as smart money's fingerprint. It's the evidence they were there, collecting orders before making their move. No fingerprint, no smart money involvement, no valid order block. Rule number 2. Inefficiency and imbalance. Let's say the last bearish candle has swept the previous candle's low, and after that, price shot up aggressively with a series of bullish candles. Now, if you look closely at the candles that formed right after the order block candle, you'll often notice something interesting. Between the first candle that means our order block candle and the third candle in the sequence, there's a visible gap, a space where the wicks don't overlap. This gap is what we call a price imbalance or price inefficiency. You might also know it as a fair value gap or FVG. If you draw a box between the wick high of the order block candle and the wick low of the third candle, you'll see a clear gap between them where price moved so fast that no proper trading took place. When this kind of imbalance exists right after an order block candle, it adds strong validation. It tells you that the move was so aggressive, so dominated by one side, that price left behind unfilled orders in that gap, and the market tends to come back to fill those gaps. However, there's a catch. If the third candle's lower wick reaches all the way down and taps into the order block area, then the imbalance has already been filled. There's no gap left. The pending orders that were supposed to bring price back have already been executed by that wick. In this case, it becomes an invalid order block because there's very little reason for price to revisit that zone. Rule number 3. The order block must be unmitigated. Any valid order block stays valid only as long as it remains unmitigated, meaning it has only been used once, or more precisely, it hasn't been touched yet. Let's walk through this. Say a red candle swept the previous candle's liquidity, and there's an imbalance present between the candles that follow. So far, all signs point to a valid order block, and there's a real chance that price will come back to this zone in the future and reverse. But then, if a subsequent candle's lower wick touches the order block zone, the block becomes mitigated. The pending orders that were sitting there have now been filled. And here's the critical rule. An order block can only be used once. Once it's mitigated, once price has tapped into it, it's done. Those orders have been filled, and there's no reason for smart money to bring prices back there again. This is one of the most common mistakes traders make. They see a zone that worked once, and they keep trying to trade it off again and again. But a mitigated order block is a dead order block. Move on and look for fresh ones. Rule number 4. Valid break of structure plus inducement. Price is making higher highs and creating valid breaks of structure as it moves up. Near the last swing low, price launched a strong move upward and broke through the previous swing high. That's a valid break of structure. Now, as price came down toward that swing low area, the last bearish candle broke below the previous candle's low, sweeping the liquidity underneath. That satisfies rule number 1. The candles that followed created an imbalance gap. That's rule number 2. And no candle's wick has touched the order block zone yet, so it's still unmitigated, satisfying rule number 3. So 3 out of 4 criteria are met. But there's one more piece that makes this setup truly high probability, and that's inducement. Inducement is when price approaches a structure level and creates a fake move to trap retail traders. It makes it look like an important level, like a resistance or support, has been broken. Retail traders see this, get excited, and jump in. But the moment they enter, the market reverses sharply and wipes them out. This is smart money engineering a trap to generate the liquidity they need. You can think of inducement as a fake breakout. It's one of the most important concepts in smart money trading, and we'll cover it in much more detail in upcoming videos. For now, just understand that inducement is the bait that lures retail traders in, so smart money can use their orders as fuel. Here's how it plays out. Price approaches the previous swing high and creates a strong breakout candle. It looks like a legitimate breakout. A bunch of retail traders enter long trades in the direction of this breakout, but then price reverses, hunts all their stop losses, grabs their liquidity, and comes right back down to our order block area. It touches the order block zone, fills the remaining pending orders, and then shoots back up, continuing the original uptrend. So to summarize, a fully valid order block requires all four of these elements: liquidity sweep on the last candle, inefficiency or imbalance in the candles that follow, an unmitigated zone that hasn't been touched yet, and a valid break of structure with inducement. When all four are present, that's when the order block truly works at its highest probability. And remember, order blocks work in both bullish and bearish market structures, and you can use them on any time frame. But the higher the time frame, the more accurate and reliable the order block tends to be. Let's now look at how to actually enter trades using order blocks. Here's a 5-minute chart. After the open, price moves down and then creates this type of price action, breaking above the swing high, which gives us a valid break of structure. Now, when price makes a strong move upward from below, the last bearish candle broke below the previous candle's low, sweeping the liquidity beneath it. After this red candle, two small candles form on the chart whose opens and closes fall roughly inside or around the red candle's body. So we treat these as inside candles. The strong bullish candle that follows creates a big imbalance. No candle has touched the order block zone yet, so it remains unmitigated. Plus, we already have a valid break of structure. All four criteria are met. We can now consider this a valid order block. Great, we've identified the valid order block, but how exactly do we enter the trade? There are mainly three ways to enter an order block zone. Type number 1, entry at the top of the order block. You place your limit buy orders at the starting point, the very top of the order block zone. Your stop loss goes below the low of the order block candle. The advantage here is that even if price dips into the zone briefly with a long lower wick candle and taps just the top area before reversing, your limit orders are already sitting there. You won't miss the trade. Entry type number 2, entry at the 50% level. In this approach, you plan your entry when price reaches approximately the 50% mark of the order block area. Your stop loss goes slightly below the order block area with a small buffer zone. This entry type is especially useful when the order block candle is very large in size, because entering at the 50% level gives you a tighter stop loss and a better risk-to-reward ratio compared to entering at the very top. Type number 3, entry at the bottom of the order block. Here, your entry is at the lower levels of the order block zone, with your stop loss shifted even further below. The downside of this approach is that price very often just taps the top of the order block or reverses around the 50% area without ever reaching the bottom, which means you could easily miss the trade entirely. That's why most traders avoid this entry type unless they have very strong additional confirmation. Now let's understand some important key points about valid order blocks. Point number 1, don't fixate on candle color when marking order blocks. In a bullish trend, if price is moving up from below and a green bullish candle breaks below the last bearish candle's low, that green candle becomes the order block candle, because its low hasn't been broken yet. The color of the candle doesn't matter. What matters is whether the candle swept the previous candle's liquidity. The same applies in a downtrend. If a red bearish candle breaks above the last green candle's high, that red candle can be considered the order block candle because it swept the liquidity above. Point number 2, any order block remains valid only as long as it stays unmitigated. The moment the price taps a valid order block even once, it's mitigated, and from that point forward, it's no longer useful. An order block can only be used once. Once those pending orders are filled, smart money has no reason to bring prices back there. Point number 3, In a bullish market structure, you should always be marking bullish order blocks and planning long trades accordingly. In a bearish or downtrend market structure, you should be marking bearish order blocks and planning short trades. Always trade in the direction of the market structure, never against it. If you found this video helpful, don't forget to like the video and subscribe to the channel. Thanks for watching.